Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London, UK feed wheat. Paris milling wheat. In late May, prices moved down and away from arguably the most difficult overhead congestion on my daily chart between 267 to 270, where the market was capped and turned into a V-top. Prices headed lower within a June-based, quite acute bear channel, exiting out at the long moving average, currently at 225, with nearby influence from the significant supports at 227, the now dipping medium moving average, currently at 233, the bright red neckline extension of the June to November 2023 head and shoulders top, currently 237, and under the overhead congestion between 238 to 242, containing the March 2013 high at 240. Of all these, the two most important were and are the bright red neckline extension overhead and the long moving average below. The market had in July and August, going into September, hesitated, dipping, then pulling back up, forming a late June to early September bear channel, verging on being a descending expanding wedge pattern. For this reason, I said here 13 weeks ago, and I quote, V-tops, such as this one here, sometimes have a handle or sideways action, end of quote. The pressure in any V-top with an extension would be for lower prices, and so we saw an attempt lower in late August, eventually making a separate small V-bottom over late August, which was, interestingly, cut off as an island bottom with two changeover gaps highlighted on my daily chart, one in early August and one in early September. The gapping move higher in early September overcame the 50% absolute Fibonacci line at 219, the upper trend line of the descending wedge pattern, as well as the flatlining short-medium moving average, currently 224, and the long moving average. The 50% absolute Fibonacci line and these other moving averages are now supports. We then had a fairly free area until we've come up 3 weeks ago to two principal resistances: the mauve medium moving average and the bright red neckline extension. These stood in the way of a number of potential pattern targets. They were target X at 238, the primary target for the descending wedge pattern, target X1 at 237, the primary target for the island bottom, and target X2 at 241, the combined secondary target for the descending wedge pattern and the island bottom. They are mostly within a 238 to 242 congestion band containing the March 2013 high at 240. This week the market tackled these topside resistances and targets and achieved all of them, but at a cost. Prices had spent their energy getting up there, but they seemingly had little to sustain the move up, and over the last two sessions prices have pulled back lower. The action nevertheless created what looks like a late August to date rising expanding wedge pattern, currently 234 to 261. I am not overly enamored with this pattern, but it still does exist, and for now I'd suggest utilizing it until something else, probably better as well, turns up. Further up we have a fairly free area up to another congestion band between 252 to 255, possibly extending down to 250. 3 weeks ago I said, and I quote, "It all depends on what prices do with the mauve medium moving average and the bright red neckline extension," end of quote. But now we seem to be trying to at least stabilize over the mauve medium moving average and the bright red neckline extension. Minneapolis wheat. Back in late February 2023, and especially at the start of April last year, so that is now outside the parameters of my daily chart, the market constructed a large bear channel that morphed into what is now on my daily chart, a descending expanding wedge pattern, currently 666, yes I know it's that number, 666 to down well off the bottom of my daily chart. The upper trend line is currently being tested by the market and has been escorted and reinforced for quite some time, though not very well I have to say, by the declining gold long moving average, currently 662. I've kept this breached large original descending wedge pattern still on my daily chart, as others that were here originating from August, September and October 2023 through to April 2024 have all been thoroughly broken, and this largest one is still here, even if it was previously breached, as a just-in-case situation. Going back to the market action, prices turned lower for V-top at the end of May, heading down in a very narrow and acute bear channel. The market exited out of this pattern at the start of July, held up by a combination of the October 2018 high at 611 and the April 2021 low at 606, and most importantly, on approach to the green highlighted September 2019 to date uptrend. Currently, well, it was green highlighted, it's not highlighted anymore, where it's currently at 596, which held things up despite what turned out to be a breach in the middle to late August. During the course of its time being held up, the market created what initially looked, and still does, a more or less dark blue sideways expanding wedge pattern, currently 569 to 680. However, within this expanding wedge pattern, the market also created a bearish cat's ears pattern over July. The pattern was triggered 6 weeks ago, but failed to reach down to its target level below, instead turning back up short of it, back up within the dark blue expanding wedge pattern, and over the breached uptrend, and importantly, back up over the neckline for the cat's ears pattern. 4 weeks ago I said of this move back up, and I quote, "It has not been enough, not yet at least, for me to consider this to be a fresh move higher." Overhead we now have the congestion from January to March 2021 between 625 to 650. Then congestion at 635, a congestion band between 650 to 656 containing the medium moving average up, currently at 642 actually now at the moment. Congestion between 666 to 676 containing the dark blue upper trend line of the expanding wedge pattern, the May to August 50% Fibonacci line at 669 and the long moving average. All these are also within a wide congestion band pre the mid-year V-top formed between February to April between roughly 635 to the May 2021 low at 676, end of quote. I further added, and I quote, "These last 2 weeks," so that is now between 5 and 3 weeks ago, "these last 2 weeks have seen a significant recovery, but I have my doubts about the stability and the sustainability of this rise right now. I'm not writing it off, but I think it will need a lot more convincing, I should say, for me to see this as a significant move higher. I'll be watching this market closely," end of quote. Well, the market did what it needed to do, and prices rose higher against my doubts, in the process forming the beginnings of a smaller ascending expanding wedge pattern, unhighlighted as yet on my daily chart, because I am not too sure of it. Currently at 632 to 702. However, there is one important, I suspect, key feature that could make this the next true driver of the market, and that is we are set up this week to make a weekly key reversal here. Thus, if we close tonight either over 631 or under 629, then we'd be on. Anything in between would have a lesser outside week. Right now we are looking very much at a weekly key reversal up. This could very well be a key moment in the development of this market. London UK feed week. I have tried this week to tidy up this daily chart, but I am still sorry to show you this daily chart that looks so colourful, messy and condensed. There's a lot going on here. In mitigation, there is a lot going on here. Hang on a second, let me just get that right. And it's going on in a relatively narrow range. The bullish incentive seen here in the spring was eroded through May, enough that we saw the creation of a V-top pattern with a very sharp downward slope. That became, and here's the leap of faith I'd previously asked you to make on my commentaries here, and do so again this week. The V-top became a V-top with a ghost extension that was caused with the changeover in early July. The construction of the second part of the V-top was the very late May to late June, very acute and narrow bear channel. This bear channel overcame all the congestions on the way down except the one at 164.95, just above the combined lows of July 2021 to May 2023 at 164 even. This congestion caused the market to exit out of the small bear channel. We then had the changeover gap, a large one between 170.40 to 196.45, and created a narrow and long descending wedge pattern. In mid-August, prices dropped away below this pattern, but chose to not really move away from it, moving back within and without it during September. I will deal with this shortly, but first I'd like to talk about the big, and it is a big leap of faith. It is to imagine this descending wedge pattern, this one here, tacked onto the end of the small bear channel, and thus we would have, as we have seen elsewhere in the other grain markets, a V-top with an extension. only here in truth it is not. Anyway, from that break lower in mid-August, the potential was for lower prices, possibly as far as the June low at 164.95. And prices tried, but had limited success. The primary target was achieved, but not the hardest to reach secondary target, though we did see for a brief moment the market under the bright red middle time, currently at 174.45, of the recent late May to early July bearish shift pitchfork. However, prices recovered higher. Now, 3 weeks ago I stated, and I quote, "Though we have bounced, it looks right now like a bounce that may not be sustained. Hence watch those supports again closely in case we see them tested, as below these, especially below the bright red middle time, we have the dark blue lower time, currently 175.95, of the significant early March to late June bullish Andrews pitchfork. This last dark blue pitchfork is the only bullish pattern, bar I suppose the gold long moving average, which is flatlining anyway, left on this daily chart, unless the market chooses to construct a new pattern." End of quote. Thus, we now have below some immediate support from the September 2021 low at 181.70, the absolute Fibonacci line at 180.5, the combination of the March to May 50% Fibonacci line at 178.25, and the flatlining long moving average. Then this week prices pushed higher again, up and out of what is left of the descending wedge pattern, managing to gap up over the medium moving average, currently 185.05, and the green highlighted short medium moving average, currently 186.20. This sudden volatility is explainable in my commentary from last week, where I quote, "Now, as I've said elsewhere, watch out for volatility around the pitchfork tine crossovers. Usually I apply this to tine crossovers of the Andrews and shift pitchforks for the same move, which is an important point. However, I am not being so strict here. So I just say caution on this, as the next crossover of sorts is on today, the 27th of September. It hasn't been today, but watch out for the next few days." End of quote. This was the reason for the sudden spurt higher. However, and there is always a however, I am not enamored with the price action over the last 3 days this move higher, as it may possibly be forming a 3-day bearish evening star pattern, and thus possibly filling in the gap left over from earlier this week. We will only know for sure early next week, so caution, watch out, just in case. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Toftbeek and ADM Investor Service International Limited. And here comes the final important bit.